If you were looking at this chart, you'd most likely be looking to buy from here, with your stop loss placed right here. Unfortunately, this is common knowledge, which means market makers are aware of it too. So when price returns to your entry, they can drive price lower, take out your stop loss, and use that liquidity to fill their buy orders. Some retail traders understand this. Instead of buying when the typical retail trader would, they wait for the market makers to make their move. Only after the liquidity has been taken do they enter the buy. This is known as a liquidity sweep entry. And instead of complicating it like most people do, I'll show you 3 different ways to trade liquidity sweeps and when to use each one. The first one is liquidity resting below higher lows and above lower highs. In a bullish scenario, when price creates a higher low and a higher high, don't rush to buy from the next available order block. Instead, wait for price to take out the higher low and reject quickly before creating a new higher high. This shows that the market is still bullish even after taking out the higher low. It also confirms that the liquidity sweep has already happened, making it safer to buy from the impulsive move. Let's look at a chart example. Here, we can clearly see that price is in an uptrend, but we don't immediately start looking for a buy entry. First, we need to see a sweep of a low. As we play price forward, we see price trade below this low and immediately reverse. Next, we need to see price break structure to the upside. Once that happens, we confirm that the bullish structure is still intact and that price has already swept the low. We can now enter from this order block and target the next high. The second one is liquidity resting above a resistance level and below a support level. When price approaches a resistance level, you would typically look to buy after the breakout, with your stop loss resting around this level. But market makers are aware of this as well. They can push price above the resistance to create the breakout retail traders are waiting for, then immediately sell back down, taking out their stop losses and using that liquidity to drive price even lower. With this information, you don't enter at the breakout. Instead, you wait for the liquidity sweep to happen, then look for a point of interest to participate in the move to the downside. Let's look at a chart example. Here, we can identify this level as support because price is rejected from it multiple times. Now we wait for the sweep. After the sweep occurs, price breaks this high, confirming that we're about to move higher. We then mark out this fair value gap as our point of interest and target the higher levels. Lastly, we have the AMD setup: accumulation, manipulation, and distribution. When price is moving sideways, retail traders typically look to buy at support and sell at resistance. This means there are stop losses on both sides of the range, creating liquidity that's waiting to be swept. This is the accumulation phase. What we want to do is wait for one side of the liquidity to be swept. Once that happens, we have the manipulation phase. Next, we identify the fair value gap created during the manipulation. This becomes our point of interest for participating in the main move, which is the distribution phase. You also want to make sure the setup aligns with the overall trend of the market. Let's look at a chart example. First, we want to see price moving sideways. Then, we wait for one side of the range to be swept. That sweep creates a fair value gap, which becomes our point of interest for participating in the main distribution.